Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I offer in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn & Associates with your financial market update, and this is for Tuesday, the 7th of March, 2017, getting on to 4:15 p.m. Central Standard Time. Well, if we take a look, the stock market down again today, and that's going to cause the embedded readings, which are the slow stochastic readings that were going sideways, locked into an uptrend, to reverse, and now the market becomes an overbought condition in need of possibly further correction. I think it does, maybe back to some key moving averages. The gold market, the silver market, getting hit pretty hard today as the market is anticipating the, number one, the European Central Bank meeting this week, and where they hold interest rates fairly steady, but then looking at the Fed getting onto its movement of interest rates, and no matter how you look at it, higher interest rates, stronger dollar, not the exact recipe for strong gold. And as you can see in the dollar index up against most of the foreign currencies, and even with Brexit, a big question what's going on there, because now the House of Lords and House of Commons that are fighting. You couldn't get the gold up. You couldn't get the gold up today off of North Korea successfully firing 4 missiles. From what I understand, they had 1 dud, and now we're moving in the THAAD system, and gold still couldn't rally. So you look at that. You look at the energy market, where finally gasoline is coming alive, whereas you're getting still beaten up in the nat gas from the mild weather, and crude is just sort of stuck one more time. So as we take a look at stock indices, you can see you've gone up, you're getting a small minor correction, you're down 68 points for the week. Everybody has to understand you went up dramatically a week ago. When President Trump was talking to the joint sessions of Congress, we had a monster rally the very next day. So we're giving back some since then. Okay, nothing wrong with that. And you get to see this even clearer as you can see the successive closes that are coming in lower from the 21,091. We're now down from that number, what, about 90 points, something like that. So, you know, interesting where you're at. You see it on the bar chart as the market's just drifting down, but none of these patterns yet show anything to worry about longer term as a chartist. I mean, I can't tell you what the future holds, but I can tell you what the current patterns look like. And the current patterns are all still with the pattern of higher lows, higher highs, a correction taking place. That's the swing line, and it shows you where the break lows and the rally highs are as apexes. Let's assume the market does break. Likely, the 18-day average will be the first number, as I teach in my charting course, where this market wants to go to do what we call a reset. Now, what I call a reset is markets that get away from some key averages often go back to them to take a break, to figure out what they want to do next in the marketplace. That's my theory. Doesn't mean I'm right, but it's what I teach in my charting course. And the market has already hit the upper Bollinger Band. It ran against it here. This is called just coming back up to it, and now it's setting back in. In addition, and I consider this extremely important, you now have 2 days. One, let's take a look and make sure I'm right. I'm wrong on this one. Some of the others did. On the Dow, you kept the embedded reading yesterday. You lose it today. The only time you can get it back after you've lost it is the very next day. So if this market had a big rally tomorrow, it could regain its all-out bullishness if this number, the slow stochastics, both are over 80. Now, some of the other indices, such as we're going to get to, you'll see in a minute. Let's take a look. Here is Monday. You lost your embedded reading. All it takes is one of the numbers of the slow stochastics after they've been going sideways, as you can see both in the number and right through here, after a prolonged period, and one of them gets under 70, twice in a row, game over. Now it has to rebuild. It's just a market that I'm going to call now overbought. But all that it calls for, under my theory, is that the market go back to the 18-day average of closes. The shorter amount of time it does, the better. The longer it takes, well, that means the market probably just going to drift around for a while. So we have to wait and see how that's going to play out here. But if you'll notice, the 18-day average is just shy tonight of this swing line, and it's going to get over it tomorrow because it's going to use the last 18 closes. And we know that that takes you back here, and they're going higher all the way through. We're going to lose these in the math of it. So this number probably gets up to that. Going to be an interesting day if it slips there. When we get to the NASDAQ, you lost the embedded reading today. Yesterday you had it. Here too you can get it back tomorrow with a strong rally. If you lose it, or if the market wants to drop, what number do you think we might go to is what you have to ask yourself. Well, I'm going to say that the market might go down to the 18-day average. Is this market in a buying pattern? It can't be if you've got a pattern of lower highs and lower lows. You're now fighting the market. You've got the swing line down. You've got the 18-day average prices over it, so you have upside bias. Let's go to the S&P. Still in a bullish bias because you got higher lows and higher highs, and the same thing in the Dow. Now, the weakest sister of them all is the Russell 2000, and it went down to the Bollinger Band today. So this market's had a pattern of a higher high and a lower low. It has had a lot of trouble, and I'm expecting it to spin around in these Bollinger Bands unless all the indices come apart. It's very oversold. It would not surprise me if the pros took money off the table today. Being that oversold at a Bollinger Band, what are the odds of staying under Bollinger Bands? 5% of the time. And if you look at the close, 1373, it's under the lower Bollinger Band. Doesn't mean it has to immediately pop back over it. It can push it, but you're asking the percentages, and I'm telling you what I think the pros do. I have also been, I think, clear as can be that this is just chopping back and forth, and what's going on. The VIX isn't giving you any idea what's happening. It's not doing its job, in my opinion, right now. You've had a bull market in stocks. This has gone down, but it could have gone under 10. It could have given you an idea that the stocks are even going to get stronger. It stalled, but the stall that it did began at the beginning of the year, so it didn't keep up with stock indices going up for those higher highs. I think it's out of kilter personally. In the June 30-year bonds, the pattern is what? Bearish. Lower highs, lower lows. You're under the 18-day average. The bias is down, but you're very oversold. So, yeah, if you want to play that you're going down a little bit more, fine. But if you're playing that you're going to stay under the lower Bollinger Band, it's a bold play on your side. Doesn't mean you're going to be wrong, just a bold play. If you take a look at the 10-year notes, same thing. Now, we've all been looking at what these notes are doing, and you're up to about 2.51%. A lot of people think that 2.6 is the magic number we should get to so that our balances, if you will, the returns on money in this economy will be better, and that sort of signals that the Fed really starts moving to higher rates over time. So I'm not differing from that. These people that I listen to, from the Bill Gross to Mohammed El-Arian, they're bright as can be. I'm nowhere in their camp. And as I look at it, this market extremely still bearish, but oversold. March dollar index overbought in a nice uptrend, resistance 101.80. The question you have to ask yourself now is, gee, how much of a position in these finances do I want, these financial futures, going into the ECB meeting on Thursday? And then, of course, on the 15th, we get the FOMC announcement. I'm not saying you have to back off. I'm saying those are the risks that you're looking at in the market. When you look at the euro currency, this is classic what I teach in my charting course. Markets often go back in front of key numbers, key reports, to that 18-day average, that reset button, and they try to figure out from there what next. They sort of like to hang there, and from there they'll figure what they do. The pound keeps dropping because the House of Lords and the House of Commons are fighting Brexit. They're both fighting for control, if you will, especially the House of Lords, where Miss May can't just go out and make a deal. In order to make a deal, it still has to be approved by Parliament, and they're wresting control away from her. As they keep doing that, people realize two parts to it. Number one, how much does it tie her hands on negotiating? Number two, is it for the best or the worst part? And the market's uncertain, so the pound continues to slip here. It did get under 122 today, and that's not a pretty number. But remember, you've been down to the 120 level this year, not past history. Japanese yen, always a difficult currency to be short going into economic uncertainty because a lot of people buy this as their safe haven hedge. Now you're caught in a very narrow Bollinger Band pattern. The trend of the market is down, but it turns up if this market is able to get over 8,800. Interestingly, even if it does that on the swing line, the 18-day average is slightly above it. Is it a sell? Well, it's oversold. It's at 27.52. So it's screaming at you, problems. Let's take a look at the WTI crude. How often are you seeing this 18-day average hit? And this is the problem and what I try to teach. When markets don't know what they're doing or they start going in these sideways bands, you can get all these big bets you want from everybody saying crude oil's going up to $58 to $60 over time. They may be very right. Over time, I think they are right. But, and there's a big but, that's not what the chart is saying. The chart is saying you want to step in, you're going to get chop sueyed up. You're going to go to the upper band, you're going to the bottom band, you play against the 100-day average, you come up, you're going crazy, wondering why with all this news that you read every day isn't it moving. You stay away from those type of things if you're a student, as I am, of Bollinger Bands, and you realize what a sideways band can be. Now, this is not a sideways band. Finally, this band had broken out to the downside. Bingo. And when that happens, you make your move, and that's what it did. And now the question is the seasonality, because we're at the point today where the seasonality normally kicks in, where you go up from here towards the center of June as the driving season happens, as the maintenance starts shutting down in the refineries and they get ready for the season. They have to change everything over, and that's what goes on. But you can see you've got a lot of resistance between 175.08 and 174.36, the 100-day and the 18-day average, and you're not trending. You have the swing line up, the bias down because you're under that 18 and 100-day average, and you're oversold. Why waste time on something like that? Nat gas, I pointed out the other day. Here was the market close on Friday. Then you jump up and you leave a gap in the chart right here. Market has now got a pattern of higher lows, higher highs, but not over the 18-day average. Today you pull in, you're filling the gap. From here, the game gets interesting. This is where the game actually begins. Do you reestablish a downtrend, or does the market get back over that 18-day average and try to show some muscle? You know, you keep hearing me talk about my charting course, and I teach slow stochastics in it. I teach window envelopes, if you're a fan of that, how to work with Bollinger Bands, how this stuff all plays out, and where do you go. My course came out for Christmas at a great price for everybody. It was $69.95. I kicked it up to $89.95. Now, for a limited time, I'm going to put up here a coupon, Ira 15. And this is just a limited time. If you decide to buy the course, what you get in the course is you get my morning videos, my twice daily updates. My research goes by itself for $60. The charting software, if you have not used our charting software in the past, that's a $99 value in the course. Less than $15, it's going to run you $74.95, all that included. Hope you want to take advantage of it. Again, it's Ira 15. All you need to do is you're going to see on the screen here, first off, the area that says click here. All you need to do is go to our website. Whatever you're going to click, it'll take you right there to buy it. If you click up here, it's going to take you where to buy it if you're watching us on YouTube. Or underneath us, well, if you go underneath us, what happens is that's other websites, and there'll be a form that comes up. But if you go to www.iraepstein.com and then go to research, that's for one part, or education for the course. Go to the education. Come down, see what it's all about. I've created a short video for you to look at. You decide to buy it, enter Ira 15. You don't have to worry about the caps. Too many people worried about that. That'll take care of it. Limited time. It's going to be a short period of time. Take advantage. I'm Ira Epstein. Have a good day.